Some traders, worried about potential losses after entering a position, close a profitable trade before reaching the target. In today's video, we'll discuss 3 techniques to maintain a winning trade until it hits the target without hesitation. So, let's begin. But before we move forward, if there's something you find valuable, hit the like button, and if you're new, be sure to subscribe and turn on notifications so you never miss our latest uploads. I'll see you right after the intro and disclaimer. This is a 5-minute time frame chart. Here, as the market opens in the morning, it drops with a red candle. After, buyers step in, forming a strong hammer-shaped candle on the chart. The following bullish candle breaks the day's high and closes above it, building a bullish trade setup on the chart. Many traders take long positions by placing their stop loss beneath this green candle. The market rises in the direction of their trade, showing them a small profit on the screen. After some time, the price retraces slightly from the higher zone, forming 2 red candles and declining. Watching these 2 red candles, some traders close their trades entirely. Shortly after, the price once again creates a hammer candle. Observing this, a new trader enters a fresh position. The price climbs for a short while, but as soon as a red candle appears again, this trader, fearing a loss, exits with a small profit. In the same way, the cycle of entries and exits continues for the next hour. Many beginners, especially options traders, keep trading all through the day. If you observe this chart, the price has been moving in an uptrend since morning, climbing from 2147 to a high of 2730, covering nearly 200 points. If you had simply purchased the ATM option, your option premium would have gained by at least 100 points. However, due to fear of loss, you don't hold your profitable trade until the final target. That's why today we'll cover 3 key methods to hold a trade until the profit target. Let's begin by analyzing the first method. This chart illustrates your initial trade entry, with the stop loss placed beneath the low of this green bullish candle or below this swing low. As the price progresses in your favor, you begin to see profits. It becomes clear that in any ongoing trend, the price advances by making minor corrections. It moves ahead, allowing fresh buyers and sellers to participate in the market. This is the basic principle of price action. As the price rises, some buyers who entered at lower levels book their profits, leading to a small correction. But, if you notice carefully, the price dips below the higher level yet does not break the prior swing low. This indicates sellers have not taken control at higher levels, but only booked gains at this stage. Your stop loss still remains distant from this point, so there's no reason to panic or close profits since your reward relative to risk hasn't yet matured. Once the next bullish hammer candle forms, buyers who missed entry at earlier levels step in with fresh buying and drive the price upward, establishing a solid swing low support. At this stage, you simply need to shift your previous stop loss from the lower level and adjust it closer to this new swing low. Even if the market reverses here, your stop loss stands above the entry point, meaning there will be no loss. As the market continues to move higher and forms new higher lows, gradually shift your stop loss above each recent swing low. This approach ensures you no longer fear losses while maximizing profits and capturing the entire uptrend. Let's now discuss the second method. Here, after entering the trade, you see some profit on your screen, but this profit is still small compared to your stop loss. If you are an option buyer, you should always set your target using a risk-to-reward ratio of at least 1 to 2, since the success rate for option buyers is generally low. Suppose you take this trade with 100 quantity. At this stage, you can exit 50 quantity and hold the remaining towards the profit target with a trailing stop loss. Because you have already closed 50 quantity, even if the market reverses from here, you won't face any loss. With this assurance, you won't fear holding your trade for longer durations until the profit target is achieved, which strengthens your trading psychology. Now, let's move on to the third method. We know that in any market condition, our main focus is on price action, but at times indicators are also necessary. If we apply a 9-period exponential moving average to our earlier chart, you'll see that whenever the price touches the exponential moving average, it resumes its trend. But once the price closes below this moving average, the trend begins to weaken. After entering the trade, If you have already booked 50% of your position, you can keep the rest until the moving average is broken. This way, there is no need to set a fixed target in advance. However, you should only exit once a strong bearish red candle closes beneath the moving average. The reason is, the price may dip below it temporarily, but the candle's closing often remains on the upside. So, it's better to wait for the close. To apply all three methods, while entering any trade, your position sizing. Trade quantity must remain under control. Only then will you be able to hold it confidently for a longer period. If you practice this method with smaller quantities for a few months, your trading psychology will grow stronger than before, and you can gradually increase your trade size over time. That's it, traders. Thanks for watching this video. The best investment you'll ever make is in yourself. Keep learning, keep improving, and never give up. If this video gave you useful insights, drop a like. And if you're new here, subscribe and be part of a family that grows stronger together. I'll see you in the next video.